Welcome to Rachel's classroom. Uh, in this video, we will be discussing the weighted average cost of capital. In the earlier videos, we saw how to calculate the cost of capital for various sources of funds. In this, under this method, weighted average cost of capital, we will be able to find the average or the composite cost of all the sources of capital. So let's try to understand this concept by working out a couple of problems. Let's proceed into the video. The first sum is the capital structure is given and their after tax cost is also given with the proportion to the total. We are expected to compute the weighted average cost of capital. So, first column is sources of funds, equity, retained earnings, preference share and debentures. The total amount is 24 lakhs. So, 7,20,000 divided by 24 lakhs, you will get this proportion to total. But since they've already given it in the question, our work is made easy here in this case. The after tax cost is also given in the question itself. So all we got to do is multiply the proportion into the after tax cost. That is 0.30 into 0.15 will give you the value of weighted average cost of capital, and you total it. Since it is in decimal, we have to multiply it by 100 to get a percentage. So the weighted average cost of capital for the first sum is 12%. Let's see one more sample sum. A company has the following capital structure: 4,000 equity shares of rupees 100 each. So the equity share capital is 4 lakhs, preference share capital being 1 lakh, the dividend percentage is 10%, debentures it is 5 lakhs, and the interest on debenture is 11%. The current market price of the share is rupees 102. The company is expected to declare a dividend of rupees 10 at the end of the current year, with an expected growth rate of 10%. The tax is 50%. So you have to find the cost of capital for equity capital, for preference share capital and for debentures, and then calculate the weighted average cost of capital for the first scenario. Second scenario, they are to these three sources, there is one more source they are adding, that is 3 lakh 12% debentures. Okay, so over and above these three sources, they are adding one more fourth source of 3 lakh 12% debentures. They are asking us to find the new weighted average cost of capital. Again, they are giving us three situations. If the dividend rate is increased by from 10% to 12%, I mean not three situations, three different iterations, I mean corrections to the earlier situation. So let's try to solve this sum. So the first iteration, number of shares 4,000, the capital is 4 lakhs, preference share capital is 1 lakh, debenture is 5 lakhs, market price 102, dividend is 10 rupees, growth is 10%, tax is 50%. So using the given information, we are finding the cost of equity, that is dividend by market price plus growth. Cost of equity is 19.8%. Next is cost of preference share. Here we use the formula annual preference dividend divided by net proceeds. So to calculate the annual preference dividend is 10% on 1 lakh is 10,000. Net proceed is the total value of the preference share capital, that is 1 lakh. So 10,000 divided by 1 lakh is 10%. So the cost of preference share capital is 10%. Now to the third source of fund, that is debentures. So cost of debenture, we are using the formula interest after tax divided by net proceeds. Net proceeds is the total debenture value, that is 5 lakhs. Interest after tax, first we need to calculate the interest, that is 11% on 5 lakhs 55,000. Tax, they said 50% on the interest, that is 27,500. So 55 interest is 55,000 minus tax divided by 5 lakhs into 100. The cost of debt is 5.5%. Now that we have found the cost of capital for all the three sources of funds, we can proceed to calculate the weighted average cost of capital. So the first column is the names of the sources of funds, amount of the capital invested, proportion, we find the proportion by adding up all the sources and dividing each source by the sum, that is 4 lakh divided by 10 lakhs will give you 0.40. 1 lakh divided by 10 lakhs will give you 0.10. 5 lakhs divided by 10 lakhs will give you 0.50. When you add up all the proportion, you should be able to get 1. Cost of capital is the cost of capital that we found in the previous steps. Okay. Cost of equity capital, cost of preference, cost of debentures. Since we found that in percentages, we converted those values into decimals and we have entered it here. To convert percentage to decimals, you simply have to divide it by 100. So now the next step is you multiply the proportion into the cost of capital, that is 0.40 into 0.198, you will get 0.0792. 0.1 into 0.1 you will get 0.01. 0.50 into 0.055 you will get 0.0275. The total is 0.1167. So you multiply it into 100. The weighted average cost is 11.67%. We have finished only the first part. Now we have to move to the second part. So in the second part, in addition to the three sources of funds that were mentioned earlier, we are adding one more source, that is 12% debentures of 3 lakhs. Okay, so the old dividend was 10 rupees. Now since it has increased from 10% to 12%, the new dividend is 12 rupees and the market price has also gone down 98 and the growth is also 8%. So using this new information, the cost of equity now is 20.2%. Cost of preference and cost of the old debenture remains the same. Now we are going to calculate the cost of the new debenture. So new debenture is 12% debt of 3 lakhs. So you calculate the interest after tax. Interest is 12% on 3 lakhs, 36,000. You deduct the tax, 18,000. You get interest after tax. Net proceeds is the total value of the capital. So 18,000 divided by 3 lakhs into 100. So the cost of debt for the new debenture is 6%. Now armed with this information, let's calculate the weighted average cost of capital. First column, sources, amount. You add the amounts and then You divide each source by the total amount, you will get the proportion, and you multiply the proportion into the cost of capital to get the weighted average cost of capital. So the new weighted average cost of capital is 10.53%. Thank you.